ever feel like you need like a roadmap for this whole investing thing?
Yeah.
Well, today, we are cracking open one of the most legendary maps out there,
Oh, yeah.
The Intelligent Investor
Yeah.
by Benjamin Graham.
It's a classic for a reason.
It really is. And you know what I love about it?
What's that?
Even decades later,
Yeah.
the advice in this book is surprisingly, scarily relevant.
It's true. It's like Graham had this, I don't know, this ability to just see through all the noise
Right.
and get to the core principles that never change.
Yes. And he starts by asking a really, really interesting question.
Okay.
He says, are you here to invest or are you here to speculate?
Oh, that's a good one.
Isn't it?
Yeah. And it's a distinction I think a lot of people,
totally.
they don't fully grasp. You know, they might think they're investing,
Yeah.
but they're really just chasing the latest, you know.
Hot stock tip.
Hot stock tip, exactly.
It's so easy to get caught up in the hype, isn't it?
Oh, especially these days, right?
Especially today.
The market's,
Oh my gosh.
it's a lot. But Graham, he wants to help you be smarter than that.
Yes, he does. He does. Which is why he wrote the book. So in this first part,
Okay.
he defines who this quote intelligent investor really is.
Okay.
And it's probably not what you'd expect.
Really?
It's not about having like a super high IQ
Okay.
or some kind of crystal ball that tells you the future.
Right, right.
He says the real key is temperament.
Oh, interesting. Temperament.
Okay, I'm intrigued. What does that even mean in the context of investing?
So it basically means having the patience
Okay.
and the discipline to stick to your plan, even when the market is going crazy.
Because, and I've said it before,
Oh, yeah.
Mr. Market can be a bit dramatic.
A little bit, yeah. He's got a flair for the dramatic.
He really does. It's like a financial soap opera sometimes.
Totally. Yeah, and if you let your emotions get the better of you every time the market dips or soars,
Oh, yeah.
you're going to make bad decisions.
Guaranteed. That's not what we're here for.
No, 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 no.
Not at all.
Graham, he wants you to be the calm in the storm, right?
Yes.
He wants you to think long term,
Long game, yeah.
not get spooked by all the short term fluctuations.
Okay, so how does this temperament actually play out in real life? Like, can you give me an example?
Let's take the dot-com bubble.
Ooh. That,
All right, so imagine you put $10,000 into something called the Monument Internet Fund in May of '99.
okay, yeah.
Sounds kind of exciting, right?
Well, back then, yeah, everybody thought they were going to be a millionaire.
Yeah, all these internet stocks, they were just skyrocketing.
Totally, yeah.
But here's the thing. By 2002,
Hmm.
that $10,000
Yeah.
shrunk to just $2,000.
Oh,
That's how quick things can change
wow.
when you let enthusiasm and speculation drive your decisions.
Oof. Yeah, that's a very good point.
Yeah, you got to be careful.
So we're not supposed to get swept up in the hype.
Right.
How do we as intelligent investors actually approach the market?
Well, that's where this idea of Mr. Market comes in.
Okay. Okay, Mr. Market.
Mr. Market.
It sounds like this is where things get really interesting.
This is my favorite part.
So who is this mysterious Mr. Market?
So think of it this way.
Okay.
You know that friend? Everybody's got that friend
Oh, yeah.
who's up one day and down the next.
Oh, yeah, totally.
Never quite on an even keel.
I know exactly the type.
Right. Okay.
Yeah.
That's Mr. Market.
Huh.
He personifies the stock market, you know,
Okay.
always offering to buy or sell you stocks.
Okay.
But he's driven purely by emotion, never logic.
Oh, wow.
One day he's euphoric, like convinced every stock is worth a fortune. The next he's in despair, practically giving them away.
Man, that sounds exhausting.
He is, but he's also an opportunity.
Okay.
You see, the intelligent investor, you can learn to see right through Mr. Market's like emotional roller coaster.
So instead of getting swept up in the drama,
Right.
you actually use it to your advantage.
There you go. You got it. You got it. Don't let his mood swings dictate your moves.
Okay.
So when he's like overly optimistic, maybe it's time to sell.
Right.
And when he's all doom and gloom,
Yeah.
that might be the perfect buying opportunity.
I like it. Buy low, sell high.
Yeah,
Right.
there you go. Exactly.
But so much of investing is about,
Oh,
managing fear, I think.
of course.
You know what I mean?
Yeah.
Most of us are way more afraid of losses
Oh, absolutely.
than we are excited about gains,
It's human nature.
Right. It's true.
So how do we manage
Well,
that?
you're right. You're right on the money with that.
Yeah.
And that's where Graham's concept of this is another one for your toolkit,
Okay.
margin of safety.
Margin of safety.
Okay.
Think of it as like a buffer
Okay.
against those inevitable market downturns because they're gonna happen.
Right. A buffer. Okay. I like the sound of that. Tell me more.
So it's actually pretty simple.
Okay.
It means you aim to buy assets for significantly less than they're actually worth. That way, even if Mr. Market throws a tantrum and the price drops, you've got that built-in cushion to protect you.
So it's all about buying low.
Right.
But how low is low enough? I mean, how do you determine that margin of safety?
That's the real work of an intelligent investor.
Okay.
You got to do your research.
Right.
You have to look at the company's financial statements, understand their business model,
Yeah.
analyze their future prospects, like where are they going?
So you're not just looking at like the current stock price.
No.
You're trying to figure out what the company is actually worth.
You're trying to, yes.
Like the intrinsic value.
The intrinsic value, exactly, precisely. And if you can buy it at a significant discount to that intrinsic value,
Yeah.
then you got your margin of safety.
That makes a lot of
It's
sense.
kind of like buying something on sale,
Yeah.
right?
Yeah. Cool.
But you know it's worth more.
Right. Exactly. Yeah. So do you have, I don't know, like a real world example you can share? Like, is there a company Graham actually used to illustrate this idea?
One of Graham's own favorites was the Washington Post Company back
Right.
in 1973.
Okay.
The market was valuing this entire company at just $80 million.
Okay.
But if you actually looked at their assets, they owned newspapers, Newsweek magazine,
Right.
these valuable television stations in major markets.
Wow. Yeah.
So those were worth at least $400 million, probably much more.
So you're saying someone could have bought a piece of the Washington Post company for like a quarter of what it was actually worth?
That's the power of Graham's approach.
Wow.
But it requires patience, it requires discipline, and it requires a long-term perspective.
Yeah, that's the hard part.
It is, but it can pay off.
Right.
He goes on to lay out different strategies for different types of investors.
Okay.
He talks about the defensive investor and the enterprising investor.
Yep. Defensive versus enterprising investors.
There you go.
So which one are we? What do we do? How do we figure it out?
Well, that's the beauty of Graham's approach, right? He's not trying to
Right.
put you in a box.
Right.
He gives you a framework for figuring that out for yourself.
Okay, I like that.
Neither one is inherently better than the other.
Okay.
It all depends on, your personality,
Right.
your risk tolerance, how much time and energy
Yeah.
you really want to dedicate to this whole investing thing.
Okay, so walk me through each type.
Okay.
Who is like the defensive investor?
So the defensive investor, Graham sometimes calls them the passive investor.
Okay.
This is someone who's primarily looking for steady returns
Mm-hmm.
with minimal effort,
Yep.
They're not trying to spend hours.
So most of us.
Yeah. They're not trying to spend hours poring over financial statements
Mhm.
or, trying to perfectly time the market.
Right. Okay.
They're happy to invest in things like, index funds,
Yeah.
diversify their portfolio,
Yeah.
and essentially let it ride.
Okay. Got it.
Let it ride.
So what about the enterprising investor? They're in the trenches a little more.
A little bit more, yeah. They're willing to roll up their sleeves, do the research,
Okay.
dig deep into, individual stocks,
Mm-hmm.
specific sectors.
Okay.
They might even use Graham's value investing principles to try to find those,
Yeah.
undervalued companies.
The hidden gems, right?
The hidden gems that the market is overlooking, exactly.
Okay, so that sounds exciting,
Yeah.
but that also sounds like it could be a little more like stressful. No.
Oh, it definitely can be, yeah. There's definitely a trade-off
Mhm.
between the effort and the potential reward.
Okay.
The key here, and I think this is a theme in all of Graham's work, is
Yeah.
be honest with yourself, right?
Totally.
About what kind of investor you are.
Right.
And then choose the approach that aligns with that.
Choose your lane and stay in it.
Exactly. And don't get distracted by what everyone else is doing.
Right, because that's tempting too.
Oh, so tempting. FOMO is real. But Graham, he also lays out some classic traps,
Okay.
things the intelligent investor should always be wary of.
Ooh, I love a good cautionary tale. So hit me with those red flags.
Okay, red flag number 1, IPOs,
IPOs. Okay.
initial public offerings.
Okay.
No matter how enticing they seem, no matter how much hype surrounds them,
Yeah.
Graham generally advises steering clear.
Because it's just speculation dressed up with like a fancy name.
Often, yeah.
Oh.
And history is full of,
Oh, yeah.
IPO booms that quickly become busts.
Right.
We've all seen it.
Totally, yeah.
And remember, as intelligent investors, we're not playing the speculation game.
Right. We're in it for the long game.
We're in it for the long haul. Exactly.
Slow and steady wins the race. Okay, what's the next trap we got to watch out for?
Falling in love with growth stocks just because of their rapid growth.
Okay.
A company might be expanding like crazy, but as Graham reminds us, that doesn't automatically translate into, big profits for investors.
Right, because you could end up paying like a premium for that growth label.
Totally.
And then it could all fall apart.
Absolutely. And you need to look beyond just like the hype.
Yeah.
And really dig into the financials to see if the price you're paying is actually justified.
Right.
And Graham, he uses examples like IBM, Texas Instruments, companies that everyone, back in the day saw as these like sure things.
Right. They still had huge price swings.
Huge price swings, even though they had all this growth.
So even with these big, well-known companies,
you
can't just assume that, it's growing. That means it's a good investment.
Exactly. You got to look under the hood. And that actually leads us to another really critical point that Graham makes.
Okay.
Never underestimate the importance of good management.
Okay, so we need to look beyond just the numbers. We got to look at the people who are actually running the show.
Absolutely. Because look, you can have a company that has a fantastic product, maybe they've got strong financials.
Right.
But if the management team is incompetent,
Uh-oh.
or even worse, unethical,
yeah, not good.
That's a recipe for disaster.
Q Enron.
Exactly. The Enron debacle, right?
Yeah.
Was a very stark reminder that ignoring the people behind the numbers can be incredibly costly.
Hugely. So how do we, as intelligent investors, how do we evaluate management?
That's a great question, and it's one that, every investor has to grapple with, and Graham has some really good advice here.
Okay.
He says, start by reading those proxy statements.
The proxy statements.
They can be a little dry, I'll admit, but they are a goldmine of information about things like executive compensation, potential conflicts of interest, the overall direction of the company.
Okay, so proxy statements, got it. Added to the checklist. There you go.
Now I know we're running a little bit low on time here.
Okay.
But we have to talk about dividends because I know
dividends. Yeah.
Graham was a big fan.
Huge fan.
So tell me about that.
So Graham saw dividends as a sign of a company's financial health.
Okay.
And a management team that's actually committed to rewarding its shareholders.
Okay, but here's the thing, like so many companies these days, they're saying we're reinvesting our profits back into the business. It's going to lead to, even greater growth down the road.
Right. And they're not necessarily wrong.
Right.
But Graham would say, if a company isn't paying a dividend, you need to understand,
like, what are they doing with the cash?
What are they doing with that cash?
Yeah.
And is it truly in your best interest as a shareholder?
Right. Because it's like they're saying, like, trust us. We're going to make you more money this way. But can you really trust them?
That's the $1 million question, isn't it?
Right. And it's one that you, as the intelligent investor, have to ask.
Wow, there's so much to consider here.
There is.
This has been an amazing, amazing deep dive into the intelligent investor.
It's a great book.
It really is, and it's really relevant, even though,
I know, it's stood the test of time.
It has. It really has. So is there like one final takeaway?
Oh, final takeaway.
The last gem of wisdom that we can leave our listeners with.
I think if I had to boil it all down to one thing, don't get too caught up in the complexity of the market. You don't need a PhD in finance to be a successful investor.
Right.
Remember what we talked about at the very beginning. Temperament, I think, trumps intelligence.
Totally. Keep a cool head.
Yes.
Stick to your plan.
Exactly.
Don't let Mr. Market throw you off course.
There you go. You got it. And always remember that margin of safety.
Such great advice. A huge, huge thank you to our expert for walking us through this incredible book.
My pleasure.
And to you, our listeners, for joining us on this deep dive.
Yeah, thanks for being here.
We hope you walked away with some really valuable tools for navigating this exciting and sometimes overwhelming
world
of investing. Until next time.
Happy investing.
Happy investing.